Okay, so in part three, this is where we look at the macro outlook and what to expect moving forward. So the markets seem certain the deals will be done to raise the debt ceiling in the US. You know, it's $31.4 trillion already. And of course, that's going to be added to whatever is agreed. Yeah, and you know that's actually seen as positive for the markets or by the markets. Uh, you know, where's it going to go to? It could be 32 and a half. It will depend a little bit on what the Republicans want. You know, obviously there's some horse trading going on at the moment to for them to back that, and if they will back it. But on Friday, talks did end abruptly, you know, with the Republicans walking away from the table. Uh, but, you know, they are expected to continue this week. But time is running out. You know, Yellen's already warning they've only got just over $50 billion left, you know, which sounds a lot, but, you know, that will run out soon with all the costs that they have on a daily basis, let alone a weekly basis. Now, Powell sort of finally indicated in his speech on Friday the Fed could be close to done on rate hikes. I still think, you know, data's got to be the deciding factor there. And of course, you know, I think probably for him, as with probably a lot of economists, that this bank lending tightening, you know, it's going to almost act as if there's been another rate hike because it's going to be harder to sort of access cash, you know, by borrowing it. That is, and you know that in turn should reduce spending, I guess. You know, I'm surprised how many experts and economists still expect rates to start to fall before the end of this year. Personally, I just don't see it. But you know, you know, even if they can get inflation back to this 2% target that they're aiming for, they're going to want to see it there for months before they're confident enough that they've got it beaten, and they're not there yet. But of course, you know, as the year goes on, we'll see whether I'm right or not. That does sort of leave open the idea that a recession is still possible. You know, again, if there is, it's more likely to be technical. It's more likely at this stage to be short and possibly shallow. But there's, you know, these things can change so quickly in these markets as we keep seeing. And I would definitely keep an eye on jobs data. You know, these jobless claims and unemployment rate levels. Uh, you know, the rates, unemployment rates are going up. The only exception really seems to me is the US. Some Fed officials, you know, the speakers from last week, they're still hawkish. You know, inflation still remains sticky. So, you know, the FOMC minutes this week could be interesting and also enlightening as to, you know, what was discussed around that. And of course, you know, with the next meeting next month in June, uh, it seems more likely at the moment that they're going to pause rates rather than another 25 basis points. Although I think, you know, at the end of the week when we get the PCE data come out, that will sort of probably provide a bit more insight on that. To me, stocks just seem a little bit overpriced, you know, especially the way they've rallied recently. You know, some of them have made 9-month highs. And, you know, for me, my question's going to be, is it a bubble? If we look back at the UK, the economy is still struggling with inflation. You know, I mean, double digits. Hopefully this week we're going to see that drop, but, you know, it's not going to drop by much, is it? So, um, however, you know, that is making wage, you know, these wage claims understandable. The fact that, you know, workers are trying to get more from their employers, but they seem to sort of fuel each other because if you're earning more, that becomes inflationary. And if inflation's increasing, then you want to earn more to sort of counteract that. So it works both ways there. And of course, with that inflation data that's coming out this week, you know, will it be below 10? Now, central banks were slow to react to inflation, and Bailey at the Bank of England, he actually had the front to say, "Don't blame the Bank of England." Yet, you know, not only were they slow to raise rates, but you know, central banks and governments in general, they're partly responsible for this inflation. You know, they put so much stimulus in over COVID and that. You know, that's pushed so much money into the system. Is there any surprise? You know, of course, supply chains were the key issue, so it was much more from the supply side than the demand side. And you know, those supply chains are continued to improve. Although I would say that, you know, the majority of countries are trying to bring more of those industries back home and produce domestically. So, you know, in the future, they don't need to rely on importing so much, especially, you know, should there be another problem such as COVID. Now, Russia and Ukraine obviously continues, although Russia did agree, a little bit surprising, I suppose, to keep the corridor open for another 2 months. You know, this is good because it allows grains to be exported, and it makes you wonder why they've agreed to that. But it does probably prevent another spike in sort of agricultural products, you know, wheat and corn and such like, which obviously would have boosted inflation yet again. I know I sort of keep on about this every week, but these food giants, you know, they're just still keeping these prices up at the highs regardless. And, you know, this, I don't know if it's a new quotation or a new phrase or not, but greedflation certainly is continuing from them. Now, oil's trading around about $72, you know, which the prices have stabilized. Which again is probably a little bit of a positive towards inflation dropping. You know, we talk about the baby boomers and the lack of workers, etc., that there are, but I think that's over time that's going to start to matter less because, you know, you're going to see a lot of these job offers disappear, and you're going to see more and more firms sort of reducing their level of workers as they try to cut costs. Just looking at a few countries and bits and pieces here. So, you know, this Japan growth could be enough, I think, to probably prompt a change of policy and see them move away from negative rates. So, you know, I've been saying since the beginning of the year that I can see that happening by summer. And I think, you know, there's still a chance I'm right there. France is doing pretty well in some ways, you know, in financial areas, because they're threatening to take some of the UK's crowns for investment and fintech. The EU's, you know, their panic last year to sort of secure all the gas that they could, LNG supplies, and also their commitment to build a lot more terminals, which, you know, which is understandable, but however, now it could come out to be a little bit excessive. Mind you, that said, you know, I'd rather that there was too much gas than not enough to keep the lights on, obviously, you know, wherever they are. But at least they're trying to do something. At least they're trying to, again, you know, bring a lot of it at home if they can. There's talks between lots of the European countries, even including the UK, of how they can generate more domestically as much as they can, of course. Instagram is planning a text app which is going to compete against Twitter, so that's going to be interesting and probably not making Musk very happy. And finally, I would say crypto prices, you know, they've remained flat again for the third week. Now, some interesting stuff here is Ripple's launched its CBDC platform because they're attempting to sort of attract the central banks and the governments, the ones that are looking to sort of create these centrally issued stable coins. And sort of connected to that sort of a little bit is Litecoin rallied over 13%. So that's for the outlook. Now we're going to move on to the technical analysis in part 4. Just again, a reminder, hopefully you've watched the other part, so you're going to find this boring, but I'm sure if you do, you're just going to move on to the next bit. But okay, so yes, we provide a daily newsletter which includes global news, my views, and also available are fresh chart levels and pivot points. Now, if you're looking to get into trading, then we offer a one-day workshop, an introduction to trading to help you decide that. Maybe you want it as your next career, or maybe just as a second income. And for anyone who's already trading, some of these workshops, because they're all on different topics, can help you fill in any gaps that you may have. And of course, all of that is going to accelerate and build on your trading skills. Now we do some 1 week courses, and of course by the end of that week you're going to feel quite confident with making decisions, understanding what's going on, but of course it's only the foundations on which to start to build your trading career. And as I always say, if you've got an inner trader, within 1 week I can find it. And also, if you didn't see part 1 and 2, we've just created a new 1 week course where at the end of it you are offered the chance to try and qualify for a funded account, which means that you wouldn't have to use your capital should you pass. If you're really serious about trading and turning it into your next career, then our accredited masterclass is the best option for you, without a doubt. It's designed specifically to provide you with all the knowledge and trading tools you're going to need. And you'll be able to navigate any market in any conditions, and as importantly, I would say, across any asset class as well. If you're already trading and you just need that little bit of help to get to the next level, then we do mentoring for that. If you're looking and needing some hedging advice, then we do that for currencies, commodities, and anything else you may need. And we are a major provider of trader educational content to individuals, exchanges, and brokers. And again, just a reminder, if you don't want to use your own capital, or you don't have enough capital, especially with these volatile markets, then maybe a funded trading account is the way to go for you. You can contact us at info@cymaxfintech.com, or you can email me at chris.tubby@cymax-int.com. Okay, so hope to see you in part 4 where we do some analysis.